Good afternoon and very warm welcome to all the participants of this webinar. You know, the UAE Corporate Tax is coming very soon. It's just staring at us around right at the door. And we thought this is the time so that all of us can understand this better, that how we will prepare ourselves for this taxation and what are the documents which are required, what are the compliances that needs to be done so that we are not falling behind the line. We should be on the right side of law always. Today we have two speakers, Vibha Malik Modi and Pranav Modi. Vibha is having over 10 years of dedicated experience in special taxation, indirect taxation, accounts, audit consultancy in the UAE and in India. And Mr. Pranav Modi is both are the co-founders of Horizon Biz Consultancy, and they are the lead team member of HBF Consultancy Private Limited in India. It's a very old firm and a broad company. Pranav is a chartered accountant with specialization in corporate startups and business setup of services. He has specialization to understand business and provide outsourced CFO services, which includes financial planning, tax planning, and strategic management and transparency. So, without further ado, and I don't want to take more of your time, let me introduce Vibha. And Vibha, welcome to this webinar.
Thank you, Rajeshri.
So, you can please carry on from here. Thanks so much.
Yeah, thank you. Thank you for your warm welcome and introduction. And good evening, everyone. I hope you will find this session useful. I have covered the few points which you have shown in the flyer itself, which is more regarding to the international taxation, corporate tax impact on the foreign companies, transfer pricing. So, as per the consultation documents, only few idea, or I will say more layout about those things are mentioned. So we try to cover those aspects which helps us more in structuring and preparing us for the corporate tax. And I got few requests more on to cover the basics of corporate tax, so that few people who missed the webinar last time, so they want to know the structure of how it is going to be the corporate tax and how it is going to impact their business. So I have covered that aspects also a little bit. So I hope this information will be useful for you. So let's start with the introduction part. So we both are representing Horizon Biz Consultancy. Horizon Biz Consultancy is more than 60 years in the industry of accounting, taxation and finance and consultancy. So we are based in Dubai and India both. You all know Delphi Star Training. Delphi Star Training is a reputed education training institute in Dubai who are providing global certification course in accounting, tax, finance, including IFRS, internal audit, renowned certifications in internal audits, auditing and many more. So let's come to our topic about the corporate tax. As we all know that corporate tax is going to implement from June 2023, and corporate tax is a kind of a direct tax which is directly going to affect our profit of the business. So as we know, this is a very new region of for the tax. UAE is very new to the tax and bookkeeping if we talk about. So there are two types of taxes, direct and indirect tax. We already have the indirect tax, which is called VAT, excise customs. So VAT is impacted directly on sales of your business. And when we are talking about the direct tax, which is corporate tax, it is going to directly impact the profit of the business. So corporate tax is going to be implemented in UAE from June 2023 as per law. But you need to analyze from your business financial year perspective that from which year it is going to implement on your business. So for example, let me give you an example to explain the scenario. Your business is following the financial year from January to December. So for you, the corporate tax applicability will come from January 2024 to December 2024. And as per the current structure of what is mentioned in the consultation document, it is more like you have to file the first corporate tax return within the 9 months of the completion of your financial year. So by that, if we will go, that first return of your corporate tax will be due in 2025 if your financial year is January to December. Then in the second example, for example, you are following the financial year of April to March, then it will be applicable from you is from April 2024 to March 2025, and then your first tax return will be due accordingly after the 9 months of March 2025. So this is about the applicability of corporate tax on your business, though it will be in force from June 2023 in UAE. Moving forward, who are the persons or who are covered under the corporate tax regime? So all the natural person who is involved in the activity which required license is covered under the corporate tax purview. If you are a salaried person, you are not covered under the corporate tax. But if you are an individual, you are a salaried person and you are involved in any other business which required or any other activity which required license as per the UAE companies law, then you are covered under the corporate tax. Legal persons, all the license holders, companies covered under corporate tax. Any person having PE in UAE, including natural person or legal person outside UAE. So what is PE? PE is a permanent establishment. So any person outside UAE having the permanent establishment in UAE is covered under the purview of corporate tax. We are going to emphasize on this topic more later. What is PE? Who are considered as who are not in the UAE but still they are liable for corporate tax in the later of this session. And other than the exempt person are also considered as a taxable person. So if anyone is missing in this one, then they are also covered indirectly under the corporate tax. So if you are talking about the exempt person, who are the exempt person which are dedicatedly are not covered under the corporate tax? So businesses in extraction and exploitation of natural resources, they are not covered under the corporate tax because they have the Emirates-level tax. Charities and other public benefit organizations, they are also not covered under corporate tax. Investment funds, public and regulated private social security and retirement pension funds are not covered under corporate tax. So this is about the applicability of corporate tax. This is a very small kind of example that how corporate tax will be calculated. As we all are aware that it is going to be 9%, there will be one rate 9% on directly on our profit, but there is an exemption limit in the which is mentioned in the consultation document, that is 375,000. So there will not be tax up till 375,000, but more than that there will be the 9%. So here I would like to mention that it's not like a VAT that okay, there is a threshold for registration of VAT is 375,000, again same mandatory threshold. But once you cross the threshold, that you have to charge 5% on all the invoices. There is no exemption in that case. But when we are talking about the corporate tax, it's not like the same. Once you cross the threshold, then the liability of corporate tax payment is there, but more than the profit, which is more than 375,000. It's not from the zero. So that is one of the things which we need to consider here. Then if there is any foreign tax credit, like if you are involved in any business who is having subsidiary and branch here and you are already paying tax on that income outside UAE, you can get the credit of that that tax, and then the rest of the is your payable corporate tax. So what is foreign tax credit, how it can be claimed, we can talk about that in the later case. Then what are the compliance and assessment are required under this corporate tax regime? You have to get the registration as you are doing in the VAT. If you are not covering, then the deregistration is also required. There is only one annual tax return you need to file, that is within the 9 months of the end of your financial year. Payment of tax and filing of return will be by yourself only. It is a self-assessed tax. So according to you, the law is there. You interpret by yourself. You calculate the tax by yourself and file the return. There will not be any intervention of the authority. But once you submit the information to the authority, then for sure there will be the requirement in terms of audit from the FTA side. Auditing of books of accounts. Currently, as per the documentation, it is required that all companies should have the audited books of accounts. The more clarification we are expecting in the upcoming final law. The maintenance of the books of accounts. So it's very deemed to be implied that if audit is compulsory, then books of accounts is also compulsory. So this is about the compliance you need to do once the corporate tax will be there. Moving forward to the major areas where we need to look into what are the nitty-gritty of the law when it comes to the complexity. So here we all are aware that free zones are they are having very complex structures and complex transactions. So we need to assess what will be the impact of corporate tax on those transactions which are with free zones. So I have divided the taxability of free zones on case basis. So if, for example, in case 1, any free zone company, free zone A is dealing with free zone B, there will the full sales of the free zone A companies to the free zone B company, there will, or the transaction wise I will say more, the transaction of free zone A to B, there will be the zero liability tax on free zone company A. As per case 2, if free zone A company is dealing with designated zone, then also there will not be any liability of corporate tax. So though the designated zone concept itself come from the VAT area law, it's for general, the designated zone and free zone are same. It just many people confuse between those. That's why I mentioned the case different, that if the free zone company is dealing with designated zone also, then also the impact will be zero. And if the free zone also, then also it is zero. But if a free zone company A is having the branch in mainland company, and that mainland company is importer on record, then that mainland company, then the liability of corporate tax on free zone company will be zero again. But the purchase expenses which is made by free branch which is in mainland, that is not considered as a deductible expenses. So if you will see the impact of this case, then you can see that the transaction between free zone A and free zone A's branch company in mainland is going to be taxed indirectly, because you are not getting that expenses claimed in the branch company which is in mainland. And very straightforward thing is, if any free zone company is dealing with mainland company, then they are covering in the purview of corporate tax. The case number 4 is, if the free zone company is dealing with mainland, and then if the free zone company is dealing with mainland and the importer on record is free zone company, then they will come under the purview of 9%. So if we want to get this exemption, let's take one example in which 90% of the free zone company sales are exports and 10% is the mainland, which is again to the branch. Then just to get the exemption for the 90% of the sales, we need to transfer the goods in the import code of the mainland branch. So this is one of the scenario I'm giving how you can plan your taxes. But if you are doing the transfer in the import code of free zone company, then the full profit is going to be charged at 9%. Let's move forward with the case number 5. So case number 5, if free zone company is dealing with a mainland company, not a branch company, it's altogether a different company which is in mainland, and the importer on record is the mainland company, then there will not be impact of corporate tax on the free zone company. Case number 6, if free zone company is dealing with outside UAE itself, there is no connection in mainland, no connection in any other free zone, there will not be liability of corporate tax on the free zone, that free zone company. Then if there is any passive income from mainland is coming to free zone, passive income means any capital gain, any dividend income, royalty, anything is receivable is from the mainland company to free zone company, then also the corporate tax rate will be 0%. So these are the cases which we are trying to explain to make the thing simple as per the consultation document. This is only a framework, this is not the final law, but we are expecting that final law is not going to be more different from what is in it. It is just little bit here and there, but free zones are not going to be 100% out of the purview of corporate tax. Though we are getting more inquiries, or I will say the queries regarding the companies who are already having the existence of free zone, and they are more into the restructuring their internal system, that if they have a branch in mainland, they are more into the export, so how they can structure the transaction. I think Pranav can help to understand more on that side, that how they can structure if you have a free zone company and the branch company is also there.
Well, it's been rightly said that you need to structure the transactions in a way wherein you are not using the import code of the free zone company to deal with mainland company. The import code of a mainland company, either it can be a branch, or even if you're dealing with any customer locally within the mainland, then better to use the import code of that customer for importing the goods locally within UAE. That is one of the scenario. Another scenario is a restructuring of the internal transactions in a way wherein your free zone company is not really getting impacted or getting attached to the transactions of a local sales within UAE. So the local sales of UAE are independent, are being made independently either through a separate entity or directly being executed in a way wherein the free zone company is not getting intervened anywhere. So that needs to be taken into a consideration to have a clarity that this is where we can claim the exemption, or I would say a zero-rated corporate tax can be availed if the transactions have been structured or done in an appropriate manner.
Yeah. So in the I can understand that this is a very complex structuring when we are talking about the free zone. So if you guys have any question, you can put in the Q&A session, and we will take the questions in the end of the session. So next, coming up to the compliances for free zone. So these are the compliances which you need to do if you are a free zone business. Though your free zone is claiming that they are the tax-free zones, but if you will go into detail, there will not be any free zone which will assure you that they are the tax-free zones. So free zones are in the scope of corporate tax. Filing of corporate tax return is compulsory for all the free zone entities, even they are claiming for 0% corporate tax. They need to inform how much sales they are making. They are not liable to pay tax, but the reporting part will be there. There has to be audited financial statements for the free zone companies, and there is an option for free zone company that they can choose to pay 9% and 0% according to their kind of transactions, how much percentage they are doing within UAE, within a free zone, outside UAE, because they need to decide. They cannot go for 50% 50% sales they are covering into the 0% and 50% sales they are covering into the 9%. There is a choice to make 0% and 9% entity wise. So if they are more into that, we are majorly in exports, then again the structure comes into the picture. They have to set up a new company in that jurisdiction, so that they those transactions which are covered into the 9% directly goes to a different entity, and they can separate the entity which is totally exempt from the corporate tax. So this structuring is going on a lot on the basis of documentation, because the framework of law is there. It's not going, the law is not going to be much difference what already there is in a document. So these are the compliances even the free zone companies also required. Then coming up to the foreign taxability of a foreign company. So even the companies are not registered or licensed holder in UAE, they can be under the purview of corporate tax. So here we are going to discuss when they are considered as a resident of UAE from the corporate tax perspective. So if they are effectively managed and controlled in UAE, then they are considered as a resident of UAE, and they are liable for corporate tax under the corporate tax regime. So how you are going to decide that they are effectively and controlled in UAE? That we need to decide on the basis of permanent establishments test, and this test is prescribed as per the OECD guidelines. So what is permanent establishment test? Permanent establishment test is to determine if and when a company has established sufficient presence in a foreign country to warrant the direct taxation of business profit in that country. So there are two tests they have defined to decide whether the company is resident in UAE or not. First is fixed place of business test, and second is dependent agent test. So what covers under the fixed place of business test is a place of management, an office, a factory, a real estate property, building site, where activities are carried on for over 6 months are considered as a fixed place of business. And any activity which is preparatory or auxiliary activities in the nature, they are not covered under the fixed place business tax. So if there is only a display of products, there is only a reprocessing of the products, there is only research or only marketing is happening from UAE, then these activities are not considered as a fixed place of business in UAE. These are just a preparatory and auxiliary activities. If they have a proper office, factory, any real estate property, building from where the business is actually managed, that pass the test of fixed place of business test, and they are considered as PE, and being considered as a PE, they are liable for corporate tax in UAE. Then the second test is dependent agent test. A UAE-based person who concludes the contracts and acts on behalf of foreign company in UAE is considered as a dependent agent. Any person who is not counted as a dependent agent if the same is done in ordinary course of business by the agent. For example, as a consultant, if you are providing any marketing research, if you are providing any kind of consultancy services which you are providing to a company which is based outside UAE, and that is your usual course of business, so you are not considered as a dependent agent of that company. But if you are hired by that company to do that specific work here, and you are concluding the contracts and acts on the behalf of foreign companies, the decision making is in your hand, then you are clearing the test of dependent agent test, and you are considered as a resident in UAE, and then you will be liable for, that company is liable for corporate tax in UAE. There is a note when we are discussing about the permanent establishment, there is a very important point. Any UAE sourced income earned by a foreign person that does not have a PE in UAE will be subject to withholding tax at the rate of 0%. So sometimes this scenario is also there, that you don't have any permanent establishment in UAE. There is no fixed property. You are not covered under the fixed place of business test. You are not covered under the dependent agent test. There is no such kind of arrangement any foreign company have, but still they are earning the income which is sourced from UAE. They are also covered under the corporate tax, though there is no liability to pay that tax, corporate tax on that income, but the reporting part is there. It is a 0% tax is there. So when we are talking about the withholding tax, maybe some of the people have the idea withholding tax is a tax when you are paying outside anything to the outside country, then you have to deduct the tax according to the liability of tax on that income. So it is for that, if you are paying any company which is outside UAE, and that income is considered as a taxable income in UAE, you have to report for that withholding tax in UAE, though the rate is 0%. I hope this is clear. If you guys have still any doubt, you can put your questions in Q&A.
Can you bit simplify it again so it becomes a bit easy, as it's a complicated topic at a large.
Like regarding withholding tax?
Regarding understanding of a permanent establishment, a bit in a part by part manner.
So permanent establishment is
how to execute a test actually, and the steps to be taken to avail the eligibility of the same.
So permanent establishment is a test which you need to do to qualify whether the income of that foreign company will be taxable in UAE or not. First of all is this: if there is a question of foreign company taxability is there, then only this test need to be performed. Then again there are two tests. One is fixed place, one is dependent agent. The fixed place is defined related to the fixed properties which I explained. The dependent test is to the dedicated person. So if any foreign company have this kind of arrangement, then they are considered as a permanent establishment in UAE and they are liable to pay corporate tax in UAE. If not, then there is no liability of corporate tax on that foreign company.
Oh.
And this is very important part here, because in UAE it's very common that foreign companies have branch and subsidiary in UAE, and they directly or indirectly covering under this purview. Moving forward about the foreign tax credit. So as I explained you that there can be the case that foreign company is not licensed here, but they are covered under the corporate tax. So, and they are paying that tax on that income in their home country also, or in the country where the company actually is established. So what will be the impact of that tax which they have paid in that country? So there will not be any double tax, on the same income. So that's why there is a provision of foreign tax credit which is introduced by FTA in this document. So if there can be two kind of scenarios: either it is a branch in UAE or there is a subsidiary in UAE. So if those kind of scenarios are there and they are clearing the test of PE and liable to pay corporate tax in UAE, then they can get the foreign tax credit which they have paid in their home country, which minimum of the credit which they can get, either the tax paid in the foreign jurisdiction, they can get the credit of that, or the UAE corporate tax payable on the foreign sourced income. So let me simplify this provision. Why the maximum credit of these is the limit is there, because in UAE the rate of tax is 9%, and for example if we take the example of in India, the rate of tax is 30%. So there is a big difference. So for example, there is a common income of 100,000 on which we have to pay 9%, and that already we have paid 30% on that 100,000 in India also. So you can take the credit of 30% of 100,000 which you paid there in UAE, and you can there will not be any liability to pay the tax in UAE. But the more amount, like the 21% which you have paid more on that income in India, you cannot carry forward the credit of the same. That is only the 9% liability of corporate tax in UAE is there, and you suffice that. That's why you get that credit. Otherwise, the 21% goes to the Indian jurisdiction, you will say. Yeah. But there is, you can get the credit, but there is no carry forward for this credit. This is only for one financial year you can get. So this is a little bit about the foreign tax credit which foreign companies have paid in their home countries. Moving forward, I think this is a very interesting topic which we all need to consider at this point of time. There is a correlation between the VAT and corporate tax. So whatever you are reporting under VAT, it need to be reconciled what you are going to be reporting corporate tax. Okay, so I have covered only few instances which can explain you how it is correlated. So this is the point where you understand why it is required to plan before the corporate tax comes into the picture. So VAT is mainly associated with sales and purchases and expenses, as we are all aware. We are discussing, we are only calculating output tax and input tax credit, where the corporate tax is on the accounting net profits. Reconciliation of VAT and corporate tax is a very important aspect, as allowable expenses under VAT might not be same as per the corporate tax. So we know that only there are the limits that only on these expenses we can get the input tax credit. These expenses are not as a allowable input tax credit. The same kind of limitation we will have in the corporate tax also. There will be the cap of expenses, that these expenses we can claim while we are calculating the profit on which we have to pay corporate tax, and these are the expenses we cannot claim. So for example, the entertainment expenses is one of the expenses which we all know is not allowable under the VAT. So you have done either you have done the huge expenses or on the as an entertainment expenses or the small expenses. It is not going to be allowed as under your VAT. Either it is for business also. So far in the documentation, they have come up with the 50% cap on the entertainment expenses, that only 50% of entertainment expenses you can claim while you are calculating your profit for corporate tax. Then again, for example, the input tax credit we are reporting in the returns. So our full year input tax credit need to be reconciled with our balance sheet of the year in which we are reporting the corporate tax. So the reconciliation of input tax credit should be same. The director's remuneration. I came across many suggestions, I will say, that if the corporate tax will be there to reduce the profit, they can pay the remuneration to their directors or managing director's salary. But we need to consider, first of all, we are awaiting the law. There will be the cap on the same for sure. But if you are paying more than 375,000 remuneration to your director, then there is a liability to the director to register them for VAT and pay 5% on that remuneration as a service charge. So you can't plan or you can't do like this. Even the cap will also be there in corporate tax, but director's remuneration you cannot be considered as a direct expense, which is, and it should not be suddenly, like the director is since 15 years in your company and suddenly the corporate tax came and you started to give remuneration to directors. This shouldn't be the case. So there are many things which you need to look into when you are planning your taxes. Reverse charge is one of the very important part when we are talking about the correlation of VAT and corporate tax. One of the reverse charge is automated if your custom code is linked with FTA. But there is another reverse charge which has come in your return is if you are importing any services which you need to report. So when the accounting of that reverse charge should be proper, and that should be reported properly under the VAT, and the same need to be reconciled with your financials when you are submitting your financials for corporate tax. Import of services, we usually miss on this point when we are submitting the returns. VAT returns, that if there is any import of service, we don't report that. But now if we are reporting, first of all we need to report that, and that need to be reconciled with your financials which you are preparing for the corporate tax. So ultimately your financials are your base. You cannot report something different in VAT and something different to corporate tax. Everything is under the purview of FTA, and they have all the information. In the later part of the presentation, we are going to cover the ESR and corporate tax also. So you get to know how all the things are linked, and you cannot give different information here, different information there. They all are under one authority, and your all information is going to one authority only. So while you are submitting any information in terms of ESR, in terms of AML, you need to be very conscious. The information should be same, because they are going to reconcile everything. Then the last is the capital expenses. Capital expenses you need to plan very properly, because as per VAT, the capital gain scheme, capital asset scheme is there. You can take the full credit of your capital expenses in one return, but there has to be proper maintenance of capital asset scheme. If you are selling that asset within the timeline, then that credit need to be reversed. While we are talking about the corporate tax, you cannot claim your capital expenses in one shot in your P&L. This is your balance sheet item, and you are only able to claim as an expense under your P&L the depreciation part. So how much depreciation, 10%, 15%, 20%, 25%, that is also going to be defined by the law, and you are allowed to get that depreciation only. So that is also very important part to know, that you are not going to claim 100% of your capital expenses under your P&L for 1 year. There has to be percentage, and that it need to be linked with your VAT. You cannot say that you purchased some asset in 2018 in which you already got the credit, input tax credit in your 2018 return, and now you are showing that again 2024 we are purchasing the same asset. So you need to plan the things accordingly. Then let's come to the DTAA and corporate tax. So DTAA is a double taxation avoidance agreements. Is a tax treaty signed by between two or more countries to avoid the double taxation of income. So currently UAE have more than around 100 countries, DTA with more than 100 countries, and they are planning to have more, because now the corporate tax will be there, and UAE is a place where people all around the world are coming and doing business here. So it is a need of an hour for UAE authorities to have a double tax treaties with other countries. And when you are advising your clients, or you have that structure, you're working in that structure where your company is based more than one countries, then you need to look into the double taxation agreements. And I think this is a need of hour to learn how to read that, and what kind of double taxation treaties are there, and how they implement in practicality. So there are three kinds of double taxation treaties are OECD model, UN model, and US models. I will not go much into the details, because this topic is very depth topic. If anyone is interested, we can have a different session itself in that one, but this is quite technical. The significance of double tax treaty is to avoid double taxation and provide more clarity to the taxpayer about their tax liabilities. So majorly the capital gain incomes, technical services incomes, dividend income, which the kind of income which are in the nature which can be earned in different two territories. So there is an agreement between those two countries that where this income will be taxation and where this income will get the exemption. So this is about the double tax treaty. But while when corporate tax will be in the implementation, then this is going to be the part of our syllabus. We need to go through this. We need to check what is the applicability of that treaty with UAE. Moving forward is this is also one of the very important topic which will come into the effect once the corporate tax will be there, transfer pricing. So many of us must be heard about the transfer pricing, but what is the transfer pricing? Let me simplify a very simple manner with you. Transfer pricing is the price for goods, services, intangible asset, or any other transactions, even the free of cost transaction between the related parties. So if there is any transaction between the related parties, so the price, that transaction is covered under the transfer pricing, and the price on which that transfer happened is considered as a transfer pricing. So the main challenge in this is mapping of related party transactions first of all, to identify which are those transactions which are covered into the transfer pricing. There is a proper definition of related party given. So if we are going to very focus on a very simple definition, so related parties are those parties who are affecting each other's decision, who are controlling each other. Those are considered as the related parties. And if there is any transaction between those parties, those are covered under the transfer pricing. Transfer pricing is a mechanism which is applied on transaction basis. So it is not going to apply on full or I will say the whole all transactions of the company. It is going to apply only on the transactions which is between the related parties. The most important and the new thing for me when I came across is that there are two kinds of transfer pricing. It is not only when there is a transaction between the related parties internationally, it is also when there is a transaction between the related parties domestically. So this is very well a very well example in UAE, because the transfer pricing between the two tax jurisdictions, and in UAE there is only one tax jurisdiction, but being UAE is a part where the free zone and mainland plays a very equal kind of role, so they are considered as a two different tax jurisdiction for transfer pricing purposes. So if there is a company in free zone and the company in mainland and they are related party and there is a transaction between them, then the domestic transfer pricing will apply to them. So there has to be the transfer pricing is the concept that the transaction should be at the arm's length price. Arm's length price is a price if that kind of the transaction is there with any other party which is not related to the party to the transaction party, then it should be the same transaction. So that you need to prove to the authority that the transaction between related parties is genuine and is at a market rate or at par. So this is a simplest way I am explaining you about the transfer pricing. There is a lot of detail you require to go through, that how you prove that thing and how you assess that thing. The main compliance part comes into the transfer pricing. You need to prepare a proper documentation to prove that to the authority, and it is not that when authority is coming to you then you will prepare. You have to prepare when the transactions are happening, and if the authority will question you, then you should have an answer. Okay, this is the reason why we have done this transaction at this price with the related parties. So this is all about the transfer pricing. If you have a transaction with the related parties, then it applies to you. But in UAE corporate tax, this is going to be the part of the region. Moving forward about the ESR and corporate tax, the way things are moving here in terms of taxation and reporting, we are expecting maybe the ESR will not be compliance, the long-term compliance for UAE companies, though we are aware that ESR is applied only on 9 activities, which is banking, insurance, investment fund, headquarters. Mainly it is holding company businesses and distribution and service center businesses which are going to face challenge when the corporate tax will come. The information they have provided to the authority under the ESR regulations need to be reconciled in their corporate tax reportings. So these are the majorly companies, holding companies and distribution and service center businesses who are covered under the ESR, and they are filing the notifications and reporting both to the FTA. So it is a kind of red alert to those that whatever you guys are submitting to authority under the ESR, be accurate with that, because they can reconcile it with the corporate tax when it comes, because they have all the details in terms of your financial when you're reporting under the economic substance regulations. Yeah, so that's it from my side. If you guys have any questions regarding to the topics which we have discussed, then I think the floor is open for Q&A. Rajesh?
We've got a few questions.
Okay.
We'll start with the one, same, my namesake Rajesh is asking, if the free zone company has part of transactions from mainland, how the corporate tax will be applicable? As such, you have covered this in your...
Okay. If the free zone company has a part of transaction from mainland, how the corporate tax will be applicable? So if the free zone company has few transactions which they are doing with mainland, so what will be the corporate tax impact for them? You are asking, right? If I'm not wrong. Am I audible?
Yeah, absolutely.
Yeah.
No.
Yeah. So if you are a free zone company and you have few transactions with mainland company, then then you are covered under the 9% review purview. So you can't get the exemption of 0% if you are dealing with mainland company as per the consultation document. I think this topic itself is very complex, so we get the more clarity in the upcoming law, but at present we will say it is going to be charged 9%.
You're right. And earlier you told that basically if you open, better to open two different companies for these things, like one for mainland, one for...
Yeah, if you are like, if your major transactions are within only free zone or in exports and you only have few transactions with mainland, then you have to see what is the profitability of the transactions, what you are doing with mainland, how you want to go with the structure, you want to continue to deal with mainland, then you need to have a different company, and altogether these things are there.
You're right, absolutely. Very
it usually depends upon the nature of a business also. Like just an example, we've been discussing the same kind of a requirement for one of a pharma company, and we need to really understand that how are they really importing the goods, or are they really consuming or storing the goods locally within UAE. So when it's not really kind of a case wherein they are not clearing the goods under their own name, they are just acting as a commission agent. It is directly being cleared under the name of the company to whom the direct sales needs to happen. So depending upon the nature and the business of a transaction in which the business is doing, the normal course of a business has been done, defines what can be the better structure for them. So one structure will not work for all, is what
you're right. It will not do. Then we now come to Viren Bhatia's question. Will interest and dividend income earned by a family office on its investment listed securities outside of UAE be liable to corporate tax?
Yeah, so will interest and dividend income earned by a family office on its investment in listed securities outside UAE be liable to corporate tax? So the chargeability of corporate tax on interest and dividend income is very wide and complex. So they have many criteria. If you will see the straightforward, it is the exempt income, but for that the lot of criteria is there, like either the beneficial the ownership of that holding, the investment is more than 10% or less than 10%. We need to check that part, then only we can say okay. And then what is the tax rate in that country where the investment is there? All those things are we need to consider, and then we can say the proper answer that whether it is charged. Interest is not going to come under the corporate tax for sure, but the dividend income, I will say that there are the two criteria we need to look at into. First is the what is the shareholding of them in the listed securities. If it is major, then we need to look it into, and what is the taxability of that corporate taxability of dividend of in that country. So that we need to consider. Yeah.
Oh yeah, correct. There are many permutation and combinations.
Yeah. So if you want to share the detail, Viren, you can email me this question. We have a email address here, and then we can take it forward from there.
You're right. Perfect. And now we come to, again, he's asking, Rajesh asking him, the passive income from UAE for mainland, free zone and offshore is not come under tax preview, like
passive income from UAE for mainland, free zone and offshore is not come under the tax preview. So I'm not understanding, it is coming the income from UAE, but for mainland, free zone and offshore. So these all are a part of UAE.
Like, according to what I understand is, they are saying that a company in UAE is receiving passive income from a mainland company, from a free zone company, and from an offshore company. So,
but from where they are receiving?
Like from this, the companies those are registered in mainland, free zone, and offshore.
Okay.
So will it be
so they are receiving from free zone to free zone, mainland to free zone? What?
The nature of a company we need to check. The registration of a company.
Yeah, I think we need more clarity on this question, because from 2 is not clear actually.
Very generic. And then Nusrat Abbas is asking for
transfer pricing between mainland related party will be applicable. No, between mainland companies related party transactions are not covered under transfer pricing, because mainland is considered as a single tax jurisdiction. So if we are talking about the domestic TP, then it is between the free zone and mainland.
Yeah, you're right. And
we are mainland company can open the free zone company same name.
If it is available, yes.
Well, if you are considering it as a branch or a subsidiary, if you are considering it as a branch, yes, of course, we can do it. Usually, it is not allowed very much with the same name, but need to check with the authority over it.
You're right. This depends on authority to authority.
Yeah, which free zone and which way we wanted to get it done.
And director's remuneration.
What is the director's remuneration? You said exempted is 375 per annum. Yeah, in the last 12 months, if the director's remuneration is less than 375,000, it is exempt from VAT. But if it is more in last 12 months, then it come under the purview of VAT.
Okay.
Thanks, Vijay. Yeah.
Generated from properties and equities.
The passive income generated from
he's putting more information to the question, Rajesh.
Okay, the passive income generated from properties and equities.
That is that passive income from UAE mainland, free zone and offshore does not come under tax for you. He's giving more information for this question.
Yes. So, for example, if income generated from properties you are talking, okay, what I'm understanding, let me try to explain. So if there is any sale purchase of property or there is any renting property, that is not a licensed activity in UAE, and you are doing that in as a individual basis. As an individual you are doing, that is not covered under the corporate tax. Okay, the equities income, if you are talking about, so it can be capital gain, it can be dividend. So what you are talking about, from where equity you are talking about, that clarity we required. But if the purchase sale of transaction you are doing in individual capacity, that don't require the license as per the company UAE company so then it is not covered under corporate tax. This is not a income tax, this is a corporate tax. So this is for companies, this is not for individuals.
Correct. Right. And then Meena Jethani is asking, free zone company having high C sales, what is the implication of corporate tax? There is no tax here. Like high C
high C sales, there will not be any tax. Yeah.
It's like not even like entering the shows, right? It is like purchased and sold like outside the group.
Yeah. So if company is only in that business, then there will not be any impact. On payment, like 9% liability will not be there, but the reporting part, we as per the documentation, I think they will ask for the return and everything, so the reporting part will be there, but we are awaiting the final law, but the 9% liability will not be there.
Will not. Nusrat is asking again, corporate VAT group will be applicable on sole establishment. No, VAT group like question.
Yeah, we have a, like in last session we had this group will be applicable on sole establishment, or if a group has mixed legal structure, what would be the impact of on corporate tax group. So we have covered the group corporate tax group last session, but sole establishment is not covered under the corporate tax group. Like if there is any sole establishment, then there is no registration of group itself. So I think we are not getting the question, but if there is one company, there is one sole establishment, you want to make a group, that is okay. There is no clarity like VAT we have, there has to be one registration when we are talking about the sole establishment, either they have different business. That clarity is not there, Nusrat. But yeah, in corporate tax, you can have a tax group.
Tax group, yeah, same like VAT.
Yeah.
So now with this we come to the end of the question session. Thank you so much, Vibha and Pranav-ji. Shyamji, you want to add something before we end this webinar?
It's fine, no problem. And thank you very much, Vibha. Thank you very much, Vibha, and sharing such a nice, wonderful.
Patient, and you answered each and every question threadbare,
from like as usual, yeah.
It's very exciting and very lively, and so much informative. Thank you so much, all participants. And we have nobody left the webinar in between. We have all, 50 of them, right, like from the beginning to the end. Thank you, all the participants. And later on, we will share the videos as usual, and the full webinar we will share. Thank you so much.
Thank you everyone. Thank you, Sam and Rajeshri.
Thank you.